Hi, my name is Dan McLaughlin, and for the next 10 minutes or so I'd like to bring you through a presentation on the Irish housing market as it stands at early October 2013. The collapse in Irish house prices was one of the most pronounced of any Western developed economy. Prices fell by 50% from the peak of the boom, with house prices in Dublin falling by almost 60%. This chart shows you the average residential price in Ireland. Market peaked in the middle of 2007. The average price was around €330,000 and is currently around €170,000. The market does seem to have bottomed though. This chart shows you the annual change in house prices nationally and also the change over a 3-month period. There was perhaps a false dawn in the autumn of 2012. You can see the 3-month change turns positive for a few months, but then dips back down over the winter months. The market does seem to have bottomed though around March. If we look at the 3-month change in prices, it's certainly quite pronounced upturn, and also we're now looking at annual house price growth. The price changes that we've seen are certainly not uniform across the country, however. This chart shows you the annual change in house prices in Dublin and in the rest of the country. And you can see there's quite a pronounced divergence over the past year or so. House prices in Dublin are rising very strongly, up over 10%, whereas in the rest of the country they're still falling somewhat, even though over the last 3 months house prices nationally have started to rise again. Why are house prices rising so much in the capital? I think it's very clear it's a supply issue. There's a lot of excess supply around the country. There's a relative scarcity of property in Dublin, particularly in areas that people would like to live, and consequently that's helping to support the price rises in the capital. The scale of the house price fall seen over the past 5 years has persuaded a lot of analysts now to point out that prices are beginning to look pretty attractive relative to fundamentals. Here we have 3 measures of fundamentals in Ireland. First of all, we have affordability. How much does it cost to service a new mortgage? And on that basis, new mortgages are something like 18% below the average affordability level going back to 1975. Secondly, we look at house prices relative to rents, and again house prices now look as if they've overshot significantly. They're something of the order of 25% below the average value relative to rents going back to 1996. And thirdly, if we look at house prices relative to income, again house prices now look fairly cheap, something of the order of 17% below the long-term average relative to income. Looking at those fundamentals in more detail, this chart looks at the average national private rent in the country, looks at the annual change, and you can see that there was a very significant decline in rents in the downturn. At one point rents were falling 20% per annum. They have recovered though, and by 2011 has started to rise again, and you can see from the chart that rents are now rising fairly strongly, over 5% up in the second quarter of 2013. In fact, over the last couple of months have now risen by over 7%. What that means is that if we take the average national rent and divide it by the average price of a residential property, we get an average rental yield of 5.7%. That's a 10-year high and compares with a rental yield at the peak of the boom of around only 3%. Here we have a chart of another fundamental variable we like, which is looking at affordability in Ireland, by which we mean how much does it cost to service a new 25-year repayment mortgage relative to one's income. If we look at that variable over way back to 1975, the answer is that on average it costs 29% of income over that period. But of course, as the chart shows, there are significant movements around that average. In the mid-1990s, for example, an average new mortgage would have only cost 20% of income to service. So that's telling you affordability is much better than the average, and that by implication house prices look fairly cheap, and indeed that does mark the start of the boom that ended in the middle of the noughties. And you can see on the chart clearly that affordability did deteriorate very sharply in the middle of the last decade. By the time we got up to 2006, 2007, affordability was dramatically worse than the norm. Begs the question, of course, how did people afford to borrow money, and why were banks lending money? And the answer is, of course, the model uses a 25-year repayment mortgage, and of course people were borrowing money for 30 years or even longer than that. We also see the impact of the collapse in house prices on affordability, because the average new mortgage is now, of course, a lot lower. Interest rates are also a lot lower, and incomes have also started to stabilize after falling very sharply for a few years during the downturn. So in 2013, an average new mortgage on our data will cost something of the order of 24% of average income to service. So it's about 18% better than the long-term average. So again, on that basis, affordability is certainly not an impediment for the housing recovery. So I think the evidence is growing that the market has probably bottomed out, and we are seeing some recovery. However, in my view, that recovery is still likely to be fairly modest in the absence of any pickup in credit. Right now, over half of transactions in the market are being funded by cash, which is quite an abnormal situation. Usually something of the order of 80-85% of transactions are driven by mortgage lending. So consequently, I think for the market to gain more traction, we really need to see a change in terms of the amount of credit being supplied into the economy. This chart shows you the number of new mortgage loans for house purchase on a quarterly basis, and you can see that the market did pick up somewhat in 2012, particularly in the final quarter of that year. But mortgage tax relief ended in the end of 2012, so that probably persuaded would-be buyers to bring forward their decision to purchase and therefore to draw down a mortgage. And you can see the payback for that in a very weak first quarter number. The number of new mortgage loans has picked up somewhat in the second quarter, and the recent evidence would suggest that the third quarter is also a little bit higher, but it's still likely to mean that the number of new mortgage loans for house purchase will remain very weak by normal standards. There are other impediments on the credit side, of course. One is the scale of mortgage arrears in Ireland. Almost 100,000 households are now in arrears on their mortgage. Clearly that's a significant factor on the credit side. And in addition, of course, what we've seen is Irish households in general trying to repay debt over recent years. Irish households are significantly indebted by international standards. This chart shows you household debt in 2005 was 110 billion and it almost doubled by 2009 to around 210 billion. You can also see that there has been some reduction in debt over the last 3 years. In fact, it's something of the order of 30 billion. So Irish households are deleveraging. However, that hasn't resulted in a very significant improvement in terms of the debt burden, which is the level of household debt relative to household income. And the problem there is, of course, that household income has also been falling. It's begun to stabilize in the last year or so, but prior to that it did fall steadily for a number of years. So consequently, we're still left with the problem that household debt is around 200% of household income, whereas the European norm is something of the order of 100%. So in that sense, we can still see that Irish households have a lot of debt, and it's very difficult to know how long this deleveraging process will continue. So what that means is that the modest increase that we are seeing in new mortgage lending is being more than offset by debt repayment. And this chart shows you the change in net mortgage lending in recent years on an annual basis, and you can see that we've been significant deceleration through 2009 and through 2010, and in recent years we're seeing credit contracting. In other words, the change in net mortgage lending is negative. Also the change, of course, in lending to households outside the mortgage sector is also falling, as indeed it is to the corporate sector. So in Ireland as a whole, and indeed across the Eurozone, credit growth is contracting, and in the absence really of credit growth, it's difficult to see, as I said, the Irish housing market gaining a lot of traction in the short term. Turning now to the supply side of the market, here we have a chart of Irish house building over the past decade. You can see clearly at the peak of the boom, Irish house completions were extraordinarily high, some 90,000 built per annum. and then a collapse over the next 5 or 6 years down to 2012, where there was only less than 8,500 completions. Indeed, over half of those completions were one-off houses, presumably built to demand. So not surprisingly, the collapse in demand for housing and the collapse in house prices meant that there was very little speculative building in the last few years. The level of house completions may have bottomed, however. This chart shows you house completions on a quarterly basis. You can see 2012 was pretty soft, although it did pick up towards the end of the year. 2013 started on a weak note, but in the second quarter we got something of the order of 2,000 houses being completed. The third quarter looks to be something slimmer or slightly better, so consequently I suspect for the whole year we'd get something of the order of 8,000 house completions, which will be slightly down on the previous year, but probably will mark the bottom of the cycle. Although the pace of house price increases across the country, of course, is very modest, so consequently it's difficult to see anything other than a pretty limp improvement in house completions over the next few years. Finally, we turn to mortgage rates. This chart shows you the average mortgage rate on a new loan as supplied by the data from the Central Bank of Ireland, and you can see that in 2013 we've seen the average mortgage rate averaging around 3.25%, which is extraordinarily low by historic standards. Where it's going to go from here? Well, what we can say is that the ECB has said that it's likely to keep rates low for an extended period. Of course, if the Eurozone starts to grow much more rapidly or inflation picks up, that can change. But most analysts believe that mortgage rates will stay low for some time. Indeed, the first increase in the ECB repo rate isn't priced into the market until right at the end of 2015. So as we sit here, it does look as if interest rates are going to stay low for some time. Well, that's it. We've come to the end of our presentation. Thank you for listening. If you'd like more information on the Irish housing market, or indeed any other issue to do with the Irish economy, please visit my website www.danmclaughlin.ie. Thank you.